It's the most wonderful time of the year. Further to my video on September 28th, it's now time to enjoy the other favorite drink of mine at Starbucks, Toffee Nut Latte. After the spooky drop on Halloween Day, the market is entering what is historically its best 6 month of the year, November through April, as Halloween strategy suggested. The S&P 500 and Dow Jones Industrial Average finished November with monthly gains of 5.7% and 7.5% respectively, marking their biggest one-month gains of the year. The major indices recovered from a negative October month as gains were driven by excitement surrounding Donald Trump's decisive win in the presidential election in early November. Stocks are hovering near record highs, consumer confidence is rising, and gas prices are lower. U.S. Treasury yields also retreated since President-elect Donald Trump nominated Scott Bessent as Treasury Secretary. So, is all this a setup in the markets for a great holiday season that is upon us? An article in investing.com titled B of A on S&P 500 post-Thanksgiving dip, ahead of a year-end rip posted on November 25th, wrote that Bank of America analysts highlighted a promising seasonal pattern for the S&P 500 as markets head into the holiday season, emphasizing the tendency for a post-Thanksgiving dip ahead of a year-end rip, particularly in presidential election years. According to the bank, history indicates a modest reversal in the week after Thanksgiving. The SPX has only increased 53% of the time since 1928, with an average return of minus 0.01%. They also note that this trend is especially noticeable during presidential election years, when the index declines 67% of the time, resulting in an average loss of minus 1.12%. Even with this short-term setback, the SPX usually shows robust returns by the end of the year. B of A reports that since 1928, the SPX has increased 71% of the time between Thanksgiving and New Year's Eve, averaging a return of 1.46%. The numbers hold up well during election years, with the index rising 75% of the time for an average gain of 1.38%. As the year comes to an end, investors are particularly drawn to two major events: tax loss harvesting and the Santa Claus rally. Investopedia defines tax loss harvesting as the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets. It further explains that most investors use this strategy at the end of the year when they assess the annual performance of their portfolios and its impact on their taxes. An investment that shows a loss in value can be sold to claim a credit against the profits that were realized in other assets. This end-of-year tax considerations plus investing holiday bonuses, a general sense of optimism and seasonal euphoria on Wall Street are some of the theories that explain a Santa Claus rally. In Investopedia, Santa Claus rally is defined as the sustained increase in the stock market that occurs around the Christmas holiday on December 25th. Most estimate these rallies happen in the week leading up to the Christmas holiday, while others see trends that begin Christmas Day through January 2nd. During this period, institutional investors tend to take a vacation and settle their books, leaving the market to retail investors, who are typically more optimistic about the market. It was shared at Investopedia that when investors look at data covering 20 years of performance of the S&P 500 in the week before December 25th from 2002 to 2022, there were 13 weeks that had a positive return, 5 that had a negative return, and 2 that had no change. It ranged from minus 10.7% in 2018 to plus 5.4% in 2021. Hence, the stock market cannot be relied upon for gifts. Investors should be reminded of rules in trading during this period. The Santa Claus rally and tax loss harvesting both present prospects for investors to optimize their holdings. But it's important to steer clear of frequent blunders, like breaking the wash sale rule or making rash trades. Also, don't let tax considerations drive all investment decisions, and don't invest solely based on seasonal trends. Make sure the stocks you buy have strong fundamentals and growth potential, and they fit in your overall strategy and goals. Always think about your long-term investing objectives and seek advice from a financial advisor to customize solutions to meet your unique circumstances. The content of this video is intended solely for informational purposes and should not be interpreted as investment advice. Wishing you happy investing and happy holidays.